You know what? Only a matter of time before the accounting profession is completely converged into one set of high quality international standards. For over a decade now, there has been advancements in converging the U.S. generally accepted principles, accounting principles, with the international financial reporting standards. As the two accounting standards continue to converge into a single set of international standards, one will realize that there are many similarities and differences between the methods. Although the differences may provoke a need for compromise, the similarities reveal that the convergence is an attainable goal. Generally accepted accounting principles, or GAAP, are the common set of accounting standards in the U.S. GAAP, issued by the American Institute of Certified Public Accountants, also known as the AICPA. And there has been an ongoing development for the past 60 years, which includes the following items of Financial Accounting Standard Boards, or FASB, interpretations and staff positions, the Accounting Principles Board, or APB, opinions, the AICPA, research bulletins, and others. GAAP establishes standards to make financial records relevant and reliable for all interested investors, stockholders, or other readers. So, GAAP and IFRS are alike in many ways, thus making the convergence a realizable task. The conceptual frameworks of both methods are very similar in nature, referring to their accounting objectives, elements, and qualitative characteristics. A major similarity between GAAP and IFRS is that both standards use an income statement, a balance sheet, and a statement of cash flows. When dealing with cash and cash equivalents, both methods are essentially the same. Another similarity is that both GAAP and IFRS prepare financial statements on an accrued basis, meaning revenue is recognized when it is realizable or realized. There are many other similarities between GAAP and IFRS and will therefore help in a complete convergence in the near future. But before there is one international financial accounting set of standards, the differences between GAAP and IFRS have been taken into consideration. One major difference between accounting practices in GAAP and IFRS is that GAAP is rule-based and IFRS is principle-based. Principle-based accounting allows for different interpretation of the same transactions, where rule-based GAAP follows a set of rules in preparing financial statements. This means there is no room for error. GAAP standards are extremely strict in accounting practices and in disclosure requirements, whereas IFRS practices are less restrictive. For example, the GAAP method is stricter when preparing income statements, where it requires use of a single step or multi-step approach. IFRS does not mention either approach. In addition to the multi-step income statement in GAAP, unusual and infrequent items must be included as extraordinary items. Extraordinary items are prohibited in IFRS. There is also a major difference between the two methods in relation to LIFO, which is last in, first out. Only GAAP accepts the LIFO method for inventory valuation, whereas IFRS can only use average cost and FIFO for inventory valuation. The differences between the two methods needs to be resolved for economic globalization. In conclusion, it is important for economic globalization that GAAP converges with IFRS into one set of high-quality international standards. A unified set of accounting standards will provide companies, investors, creditors, financial users, etc., with helpful information that is relevant and reliable for making financial decisions. The similarities with GAAP and IFRS already provide some ease with the merge. And though there are still many differences, short-term and long-term efforts are in practice with hopes to merge GAAP and IFRS in the near future.